Okay, so let's try to unpack this because I think if you've looked at, your portfolio or the news or kind of even just scrolled on Twitter for 5 minutes in the last, 48 hours, you're probably feeling a very specific kind of dread.
I think nausea is the word that comes to my mind. That feeling mixed with a little bit of betrayal, maybe.
Betrayal, yeah, that sums it up perfectly. It feels like we're caught in this, this desire loop where every single time you think things are calming down, the market just yanks the rug out.
And this time it feels different. It's not one thing.
No, it feels coordinated, like a convergence, an attack on sentiment itself.
It really is the perfect storm, isn't it? You've got the moral panic, then you have the technological panic, and of course the financial panic, all hitting the tape at the exact same time. If you're a retail investor, it must feel like the walls are just closing in.
Totally. Let's lay it out on the table. First, the Jeffrey Epstein documents drop. And it's not just the usual garbage. It's specifically linking him and his money to the very early days of Bitcoin.
Right. And then on top of that, you get this rumor mill just spinning completely out of control.
The quantum apocalypse.
Exactly. This idea that, encryption is fundamentally broken, that the NSA or some other three-letter agency has cracked SHA 256.
Which, if that were true, that's game over. Every digital asset on the planet would basically go to zero overnight.
Instantly.
And then, as if that wasn't enough to give you a heart attack, you just look at the price. Bitcoin has been, cut in half almost, while gold, the old school safe haven, is hitting all-time highs. The whole digital gold narrative just looks like it's bleeding out on the floor.
It absolutely looks that way if you're just, looking at the headlines and the ticker.
So that's the real question for today, I think. The average person listening is sitting there looking at their phone and asking, is Bitcoin morally tainted forever because of this Epstein stuff? Is it technologically obsolete because of quantum computers? Is it time to just, sell it all and buy gold bars and hide them in my backyard?
Look, those are exactly the right questions to be asking. But the answers. The answers might not be what you think they are.
Okay, good. That's why we're here. But look, I don't want the usual, don't worry, it's all fine, pep talk. This isn't just another news report. It's a deep dive, sure. But I want to frame it differently.
Okay. How do you want to play it?
I want you to put on a very specific hat for this. You're not just our expert today. I want you to be a crisis manager for let's say, a major hedge fund. And I'm the client. I represent the limited partners. I'm panicking. I see red all over the screen. I see these disgusting headlines, and my finger is hovering over the sell everything button. Your job is to either talk me off that ledge, or if the threat is real, tell me to jump.
I like that. I like that a lot. So this is an intelligence briefing, not about feelings, a forensic audit.
Exactly. I want everyone listening to picture this with us. We're not in a studio. We're in a war room. It's late. There's a single lamp on a desk. And on that desk is a classified folder, and the label says the Anti-Fragile Files.
Right. And my job is to go through that folder with you, piece by piece, to separate the signal from all the noise. Because in my experience as a crisis manager, when the retail market is screaming in panic, the smart money is usually doing something very, very different.
Okay, so what's the objective here? What's the mission?
The objective is to figure out if these risks, Epstein, quantum, the price, are fatal. Are they kill shots? Or are they actually a buy signal in disguise?
Whoa. Okay, a buy signal in disguise. That's a bold take. Because from where I'm sitting right now, with the Epstein news making Bitcoin feel kind of dirty and the charts looking like a nosedive, it really, really feels like the sky is falling.
Well, the sky's always falling if you don't understand the structural integrity of the roof over your head.
Okay, fair enough. So let's test the roof. Is it falling?
No. I'll give you the conclusion right up front. The BLUF, as they say in the military, bottom line up front. The headlines are absolutely designed to shake you out of your position. But if we actually do the forensic work, if we go through these files, you're going to see that the smart money is probably laughing at this panic.
Laughing. With the price down 50%, that seems generous.
Laughing. Because we're going to prove that this Epstein connection, as ugly as it is, actually validates Bitcoin's core principles. We're going to prove the quantum threat is a mathematical nothingburger for at least the next 20 years. And we're going to show you why that price divergence from gold is actually a feature, not a bug.
All right. I'm listening, but man, you've got your work cut out for you. Because we have to start with the ugliest file in the whole stack.
The moral stress test.
Yep. The Epstein Files. Let's open it up.
Let's do it.
Okay, so the elephant in the room, and it's a truly ugly elephant, Jeffrey Epstein, the files drop, and the entire crypto world just collectively holds its breath. What's the actual damage here? What do the files really say?
We have to stick to the facts on this one, not the Twitter rumors.
Right.
The documents confirm a few, let's say, uncomfortable truths. First, Jeffrey Epstein knew about Bitcoin, and he knew about it very, very early. We're talking 2012.
2012. Wow. I mean, that is incredibly early. Back then, most of us thought it was like magic internet money for gamers.
Exactly. But Epstein, for all his monstrous crimes, was a very sophisticated financial mind. He immediately saw the potential for a borderless, censorship-resistant way to move value. The files also show that he was, indirectly at least, funding developers.
Okay, see, this is the part that really freaks people out. Funding developers. It sounds like he was paying the architects to build a back door or something.
It's a little more nuanced than that. He was funneling money through the MIT Media Lab. Joy Ito, the director there, took a lot of donations from Epstein. And some of that money made its way into their digital currency initiative, the DCI. So it wasn't a direct check from Epstein saying, build me this, but the money was in the system. And finally, we know he was an investor. He had stakes in major companies, like Coinbase.
Okay, so he's in the water supply. He's early. He's funding research. He's investing. And the narrative the media is pushing, it's pretty simple, right? Bitcoin is tainted.
Criminal money. That's the headline.
Exactly.
Yeah.
If a monster like Epstein was one of the first guys on the boat, then the boat must be rotten, right? That's the fear, this moral panic that if you hold Bitcoin, you're somehow, I don't know, complicit in something dirty. It makes you feel gross just for holding it.
It's a very, very effective emotional argument. It completely bypasses your logical brain and goes straight for that feeling of disgust. Guilt by association, but for technology.
And it got even worse. I saw these screenshots going viral. Did you see them? The ones claiming Epstein actually created Bitcoin, that he was Satoshi Nakamoto.
Ah, yes, the infamous Satoshi email hoax.
Is it a hoax?
Yeah.
For sure, because I gotta admit, it kind of fits the Hollywood version of the story. Secretive billionaire, weird tech background, shady network. If he really was Satoshi, that's a kill shot for the whole project, isn't it?
It is a kill shot.
Yeah.
And it fit the movie script perfectly, but it does not fit the forensic reality. We need to put this one to bed right now. That viral screenshot, the supposed email from Epstein, it is a confirmed 100% forgery. The PGP keys were wrong. The timestamps didn't line up with the early block headers. It was basically 4chan trolling that the mainstream media ran with because it was juicy.
Okay, good. So we can definitively sweep that off the table. Epstein is not Satoshi.
He's not Satoshi. He was an early, opportunistic, and frankly, predatory investor.
Yeah.
But he was not the architect. But the anxiety around his involvement is still very real, and we have to address that head on.
So how do we do that? How do we reconcile this? He was involved. He did invest. Even if he didn't create it, his fingerprints are on the scene of the crime, so to speak. How does that not leave a permanent stain?
To understand this, you have to strip away all the emotion and just look at the machine, the infrastructure.
And I use a specific analogy for this. I call it the open sewer analogy.
The open sewer. Okay, that's vivid. And I'll be honest, it doesn't sound like a great marketing slogan for a trillion-dollar asset.
Just bear with me. Think of a huge city. London, New York. Underneath all the skyscrapers and parks, there's a complex sewer system.
Okay, got it.
Now, what does that sewer system do? It carries wastewater. It carries everything. Does the sewer pipe ask the person flushing the toilet if they're a good person or a bad person?
No, of course not. It's just plumbing. It's gravity.
Exactly. It serves the hospital and it serves the orphanage. It also serves the mob boss's headquarters and the corrupt politician's mansion. The infrastructure itself is amoral. It doesn't care. It just works.
So, your defense is that Bitcoin is a sewer. My point is that Bitcoin is neutral infrastructure. It is a protocol, just like the internet itself. The internet lets us have this conversation right now. It also lets terrorists plan attacks.
Yes.
Do we say the internet is evil and try to shut it down? Do we ban roads because bank robbers use them for getaway cars?
No, you separate the tool from the user. We understand that.
Precisely. And this gets to the core of what a permissionless protocol actually is. Here's the key idea. If Bitcoin could have stopped Jeffrey Epstein from using it, it wouldn't be Bitcoin.
Wait, hold on. Unpack that. If it could stop him, it wouldn't be Bitcoin. I mean, that sounds completely backward. Shouldn't a good financial system be able to stop bad people?
In a centralized system, yes, absolutely. PayPal can freeze your account. Visa can deplatform you. But the second you give a central authority the power to say, we don't like what Epstein is doing, you also give them the power to say, we don't like what you're doing.
Hmm.
Maybe you donated to a political candidate they don't like. Maybe you live in a country they've sanctioned. The entire point, the whole value proposition of Bitcoin, is that there is no central party who gets to make that call.
So the fact that a monster like Epstein could use it is actually proof that works the way it's supposed to. It's the ultimate test of its neutrality.
It is the ugliest possible proof of a truly beautiful concept. Neutrality has to be absolute. It's not neutrality for everyone except the people we all agree are evil.
Hmm.
But this is where it gets even more interesting. This is what I call the failed capture argument. And as a crisis manager, this is the headline I'd put on my report to the partners.
Okay, I'm intrigued. Tell me about the failed capture.
This is why, and it's going to sound crazy, I actually think the Epstein Files are bullish for Bitcoin.
Bullish. Come on, man. That feels like a hell of a stretch.
Just hear me out. Epstein wasn't just a passive user. He was a manipulator, a controller. This was a man with, for all intents and purposes, unlimited resources and the most elite connections on the planet. He was not used to being told no. And the files show he didn't just want to use Bitcoin, he wanted to change it.
Change it how? What did he want to do?
He was explicitly trying to create special tweaked versions of it. Things like Sharia-compliant Bitcoin to appeal to his investors in the Middle East. He was trying to use his funding influence at MIT to steer the core code. He wanted to create a version he could control, or at least one with a backdoor for his own purposes.
He tried to bend the spoon?
He tried his absolute damnedest to bend the spoon. And what happened?
Nothing.
Absolutely nothing. He failed. The spoon did not bend.
Well,
just stop and think about the gravity of that for a second. One of the most powerful, connected, and manipulative people of our lifetime tried to corrupt the Bitcoin protocol from the inside. And he just bumps off it. He's a brick wall. The code didn't change. The community of developers didn't listen to him. The nodes on the network rejected the idea. The protocol itself simply ignored him.
That is actually a really powerful point. I hadn't thought about it that way. Usually when that kind of money and power enters a system, it warps the system around it.
Exactly. Look what happens when a billionaire buys a newspaper or a social media company. The rules change. The algorithm changes to suit them. But Bitcoin, it just chewed them up and spit out without even noticing.
So that was the moral stress test. And Bitcoin passed. If a guy like Epstein couldn't capture it or corrupt it, who possibly could?
That's the question. It survived Epstein. Just like it survived the collapse of FTX. Just like it survived the Mt. Gox hack all those years ago. Every single time a villain gets involved, the price might get shaky, the headlines might scream bloody murder, but the network just keeps producing blocks. Tick, tock, next block. It's completely indifferent to the morality of its users. And for a global, neutral store of value, that indifference is its single greatest strength.
It really is the honey badger of finance. It just doesn't care.
It doesn't care. And because it doesn't care about Epstein, it means it also doesn't care about your politics, which means your wealth is safe from that kind of capture.
Okay. You know what? That actually makes me feel a lot better about the moral side of this. It's not tainted. It's battle-tested. It's stared into the abyss, and the abyss blinked.
Precisely. It's hardened.
That's only one fire we have to put out. We've got to open the second file. And this one is less about bad people and more about bad math. The tech stress test.
The quantum apocalypse.
Yeah. This one feels, I don't know, more existential. The moral stuff is a PR problem. The quantum threat, that feels like the engine itself could just seize up and die.
That is absolutely the fear. The fear is that the underlying cryptography that makes Bitcoin secure, SHA 256, the elliptic curve stuff, is about to be shattered by some new kind of supercomputer.
So let's set the scene. This isn't just some abstract rumor. People are seeing weird activity on the blockchain that's fueling this. These ancient wallets, these OG addresses from 2010, the Satoshi era, they're suddenly waking up and moving coins for the first time in over a decade.
The sleeping giants are stirring, for sure.
And the story that's being built around that is just terrifying. The narrative is they know something we don't, that these early miners, maybe even intelligence agencies, have a tip that quantum computers are coming online and are about to break everything. I keep hearing this phrase, harvest now, decrypt later.
Right, that's the general fear with encryption, that a bad actor steals a bunch of encrypted data today and then just sits on it, waiting for a computer powerful enough to crack it open in the future. But with Bitcoin, the fear is much more immediate. It's sell your coins now before a quantum computer cracks your private key and steals them. It's the ultimate ghost story.
It is a ghost story. But ghosts are scary. And like with most ghost stories, I need you to turn on the lights for me. How real is this threat today? Right now.
To get to the reality, we need to stop reading the rumors and start looking at the data. We dove deep into the latest Big Ideas report from Ark Invest. Kathy Wood's firm.
Oh, yeah. They're all about that bleeding edge, futuristic tech. If anyone would be sounding the alarm, you'd think it would be them.
You would.
Yeah.
They live and breathe disruptive innovation. Their chief futurist, a guy named Brett Winnan, has modeled this out extensively. They looked at the actual real-world rate of progress in quantum computing versus the sheer difficulty of breaking Bitcoin's encryption.
Okay, so what's the verdict? Are the quantum robots coming for our crypto next year? Because I read these articles about Google's Sycamore processor doing these amazing calculations.
It's true. It can do very specific and, frankly, mostly useless calculations incredibly fast. But cracking encryption is a whole different ballgame. This is what Ark's report calls the Moore's Law gap.
Explain that. What's the gap?
So we're all used to Moore's Law, right? Computing power doubles roughly every 2 years. Tech moves at an exponential pace. But quantum computing is bound by some really, really hard physics. It depends on creating and controlling qubits.
Right, the quantum bits. Instead of a 0 or 1, they can be both at the same time.
Correct. But here's the dirty little secret. Qubits are unbelievably fragile. They have to be kept at temperatures colder than deep space just to exist. Any tiny bit of environmental noise, a stray magnetic field, a vibration, and the whole thing collapses. It's called decoherence.
So it's not like you can just slap more quantum chips onto a motherboard and call it a day.
Not at all. It is an engineering and physics nightmare. To crack Bitcoin's encryption, you would need a machine with millions of stable, error-corrected qubits all working together perfectly. The best machines we have right now, they have a few hundred, and they are incredibly noisy and prone to errors.
And Ark's data shows that even though we are getting better, the pace of improvement isn't fast enough.
Give me a timeline. The rumors are screaming 2026. What does the math say?
The math says the mid-2040s. Wait, what? The mid-2040s.
Yes. Based on the current real-world trajectory of qubit stability and error correction. We're looking at a 2040 problem, not a 2026 problem. That is a colossal difference.
That's a 20-year gap.
It's a lifetime in the world of technology. And you have to remember, Bitcoin isn't just a static object. It's software. It evolves. If quantum computers start getting dangerously close in, say, 2035, the Bitcoin network can simply upgrade to quantum-resistant encryption algorithms. It's called a soft fork.
So it's a race, but the defender has a 20-year head start and can put on new armor halfway through the race.
That's the perfect way to put it. It's like worrying that a Formula One car that will be invented in 2040 is going to beat a horse today. Yeah, probably. But by then, the horse might have evolved into a spaceship.
Okay, but, and this is the thing that's still nagging at me. I hear the science, I get the timeline. But if the tech is safe, why are those OGs selling? You can't just ignore the fact that those old wallets are moving coins. If you were an early miner and you knew it was all safe, why sell now?
This brings us to my favorite analogy from this entire deep dive. I call it the yacht rebalance.
The yacht rebalance. Okay, I like the sound of that.
All right, let's do a little role play. You're a Bitcoin miner back in 2010. You're a hardcore tech nerd. You're living in your parents' basement, and you mine, say, 10,000 Bitcoin when they were worth like 5 cents each.
Okay, I'm there. I'm drinking Jolt Cola. I'm listening to bad metal, mining away.
Now, fast forward to today. It's 15 years later. You're not in your 20s anymore. You've got a bad back from that gaming chair. Maybe you have kids now. A mortgage?
Yeah.
But that stack of 10,000 Bitcoin, it is now worth $500 million.
Whoa. Okay. Life is different.
Life is very different. You are wealthy beyond your wildest dreams. But it's all tied up in this one volatile digital asset. Are you really going to keep 100% of your net worth in Bitcoin forever?
Probably not. No. I mean, even if I believed in it completely, I'd want to, enjoy some of it. Diversify.
Exactly. You're not selling because you're scared of a quantum supercomputer from the future.
Yeah.
You're not selling because you think Bitcoin failed. You are selling because you want to buy a damn yacht. Or a mansion. Or a bond portfolio that ensures your grandkids are set for life.
So it's not panic. It's just life happening.
It is life cycle rebalancing. These OGs are not fleeing a sinking ship. They are disembarking at their destination. They won the game.
That puts a completely different spin on it, doesn't it? We see a wallet move on a block explorer and we scream, panic. They know something.
And they're looking at their bank statement and thinking, you know what? It's finally time to retire.
It's a transfer of wealth. And you have to remember, for every seller, there has to be a buyer. Who's buying all those coins?
Well, after this conversation, hopefully us.
It's the next generation of holders. It's the institutions like BlackRock. The OGs are distributing their massive holdings to a much wider group of people. that's actually a good thing for the network. It decentralizes the supply.
So the quantum threat is really just a scary ghost story that's providing cover for people cashing in their lottery tickets.
It's a very convenient narrative for the bears, but the reality is much more boring and human.
And here's the lesson. Don't let someone else's retirement plan scare you out of your position.
Don't let someone else's retirement plan scare you out of your position. That's a fantastic line. Okay, so moral test. Passed. Tech test. Passed. But there's one more file. And this is the one that hits you right in the wallet.
The financial stress test.
The charts. We have to talk about the charts because even if the tech is sound and the morals are, let's say, neutral, if the price keeps going down, I'm still getting fired as your crisis manager.
Right. Let's visualize option C here. Picture a chart with two lines on it, a green line and a red line. The green line is gold, and it is soaring. It's hitting new all-time highs. There's geopolitical tension, wars, and gold is doing what gold is supposed to do. It's acting as a safe haven.
And the red line.
The red line is Bitcoin, and it's down 50% from its highs. It's cratering while gold is on its way to the moon.
The great divergence.
It's a massive divergence. And the obvious retail reaction is panic. It failed. It was supposed to be digital gold. If the world is on fire and gold is going up, Bitcoin should be going up too. If it's going down, then it's not a safe haven. It's just another risky tech stock.
That is the gut reaction, 100%. These two things are supposed to move together.
That's the intuition. But they aren't. And this is where we have to put that hedge fund manager hat back on. Because when I, as a crisis manager, look at that chart, I don't see failure. I see uncorrelated alpha.
Uncorrelated alpha. Okay, that sounds impressive. But if my portfolio is bleeding, I don't really care what Greek letter you call it. What does it actually mean?
Let's look at the numbers, the correlation coefficient. Ark Invest tracks this metric very closely. Right now, the statistical correlation between Bitcoin and gold is sitting at about 0.14.
0.14. Okay, for those of us who snooze through stats class, what does that number mean?
Okay, so a correlation of 1.0 means two things move in perfect lockstep. When one goes up, the other goes up. Think like oil prices and Exxon stock. A correlation of minus 1.0 means they're perfect opposites. When one goes up, the other goes down. Like the US dollar and gold? Often.
And 0.14.
It means they basically have no relationship at all. They're strangers passing in the night. What one does has almost no statistical bearing on what the other one does.
But isn't that bad? I mean, the whole thesis was digital gold. Shouldn't it act like gold?
Not if you're building a serious diversified portfolio. Think about it from the perspective of a pension fund manager. Do you want to own 10 different assets that all do the exact same thing at the exact same time?
No, because then if that one thing goes wrong, your whole portfolio blows up. It's the all your eggs in one basket problem.
Exactly. That is concentration risk. And it's what keeps institutional investors up at night. What they crave, what they hunt for, are assets that dance to their own rhythm. They want things that are uncorrelated.
So they actually want things that don't move together.
They desperately want uncorrelated assets. And this brings us to modern portfolio theory and the holy grail metric, the Sharpe ratio.
Sharpe ratio. All right, break it down for me.
The Sharpe ratio is just a fancy way of measuring how much return you're getting for the amount of risk or volatility you're taking on. You want that number to be as high as possible, more bang for your buck.
High return, low risk. Got it.
Yes. But here's the mathematical magic. It's almost unbelievable, but it's true. If you have a standard portfolio of, say, stocks and bonds, and you add a small amount of a very volatile asset like Bitcoin, but that asset has zero correlation to everything else, the overall volatility of your entire portfolio actually goes down.
Wait, what? Adding a super risky thing makes the whole basket less risky? That sounds like financial voodoo. It makes no sense.
It's not voodoo, it's just math. Because they aren't connected, they smooth each other out over time. When your stocks are crashing, maybe Bitcoin is having a huge rally. When Bitcoin is in a bear market, maybe your bonds are doing great. Because they zig and zag at different times, the overall ride of your portfolio becomes much smoother.
So when Bitcoin zigs while gold zags, that's actually proving that it's a unique and valuable asset class.
Yes, it proves it's not just tech stock number 5,000, and it's not just gold but on a computer.
Yeah.
It is something fundamentally new. It is behaving exactly like a powerful diversifier is supposed to behave.
So the smart money, the institutions, they're not looking at that chart and freaking out that it's not following gold.
No. They're looking at that chart and saying, excellent, it's independent, I need some of that in my portfolio to boost my Sharpe ratio.
That is a massive, massive shift in perspective. So
Yeah.
Retail investors are selling it because it's not gold. And the institutions are buying it because it's not gold.
You've got it. That's the entire game right there.
Right.
They aren't buying it to replace their gold. They're buying it because it's the only asset in the world with a predictable finite supply that moves independently of both the central banking system and the traditional commodities market. It's a true asset class C.
Wow. Okay. That explains why the big ETF issuers like BlackRock and Fidelity aren't panicking. They get the math.
They wrote the textbooks on this math. And they are more than happy to buy the coins that retail is panic selling because of a misunderstood chart.
Okay, so we've opened all the files from the folder.
We have.
Let's do a quick summary before you give me the final verdict. The anti-fragile files. Let's run it back.
Let's do it.
File number 1, the moral file. Epstein.
Bitcoin is neutral infrastructure. It's the sewer. Epstein couldn't capture it. He couldn't break it. It passed the ultimate stress test. The so-called taint is actually proof of its censorship resistance.
File number 2, the tech file. The quantum apocalypse.
It's a ghost story. Ark Invest data, the real physics, shows we have a 20-year safety buffer. The OG selling is just people taking profits and buying yachts. It's not a tech failure.
And file number 3, the financial file. The
A
correlation.
low correlation, that 0.14 number, is a feature, not a bug. It makes portfolios stronger by increasing the Sharpe ratio. It proves Bitcoin is a uniquely valuable asset class for diversification.
So we promised an intelligence briefing verdict. You're the crisis manager. I'm your panicked client. My hand is still hovering over that sell button. What's the final word? What do you tell me to do?
I tell you to take your hand off the mouse.
Breathe.
Okay.
Hand is off.
Now we apply the signal versus noise filter. The noise. The noise is the disgusting Epstein headlines. The noise is the futuristic quantum ghost stories. The noise is the short-term price chart going down because some guy from 2010 wants to buy a private island.
And the signal, what's the real signal here?
The signal is that the underlying fundamentals of the network have never been stronger, and they are screaming to buy. The signal is that the network is verifiably permissionless, proven by the fact that Epstein failed to capture it. The signal is that the network is secure, proven by the math that shows quantum is decades away. And the signal is that the asset is unique, proven by its lack of correlation to everything else.
So all this bad news is actually...
The bad news is a gift. It is a market mispricing risk on a massive scale. The market is pricing in total catastrophic failure based on rumors and emotion. The reality is robust, battle-tested survival. And the gap between those two scenarios, that gap is your opportunity. That's where you make your money.
That is a powerful way to end it.
Look, I'll say this directly to everyone listening. If you sold your position this week because of a fake 4chan email, or because of a misunderstood rumor about a computer that won't exist for 20 years, you need to understand what you just did.
What did I do?
You just made a voluntary donation of your wealth to the verified class. You panicked and sold your scarce asset to the very people who did the homework and understand the math. You sold your fire insurance policy to the arsonist.
Ouch. When you put it like that, it definitely stings.
It should sting. This is a game of information and emotional control. The headlines are weaponized to shake you out. They're designed to trigger fear. Your job isn't to react. Your job is to be the forensic analyst of your own portfolio.
The headlines are designed to shake you out. The fundamentals are screaming to buy. That's the quote right there.
It's the only truth that matters when a market gets this emotional.
Well, you can consider me officially talked off the ledge. I think I might actually be closing that folder and maybe opening up my Exchange app.
Not financial advice, of course.
Yeah.
But as your crisis manager, looking at this particular asymmetry of risk versus reward, I certainly wouldn't blame you.
Chuckles. Of course not. Never financial advice. Just sound logic.
Exactly.
Before we wrap this, I want to leave our listeners with one final thought to chew on.
The final provocation.
Yes. I want you, the person listening right now, to ask yourself this question honestly. Did the Epstein news make you trust Bitcoin less because of the gross association? Or did it, after hearing this, make you trust it more because a man like that tried and failed to control it?
That is the absolute crucial question, and I'll add one more. If the people who built this thing, the OGs, the earliest believers, if they're now selling their Bitcoin to go live their dreams, doesn't that just prove that the whole experiment actually worked?
Right. It wasn't some scam that went to zero. It created real life-altering wealth for the people who took the risk first.
If the experiment had failed, they'd be broke. They are selling because they won. The real question is, will you have the conviction to hold on long enough to win, too?
Man, heavy thoughts. If you want to understand the other side of this global game, how entire nations are thinking about this, you should really check out our previous deep dive, episode 121, The Golden Gambit. It's about the sovereign level strategy.
Highly recommended. It puts this whole institutional piece in a much broader context.
But for today, that closes the book on the Anti-Fragile Files. I'm your host.
And I'm the crisis manager, signing off.
This has been The Deep Dive. Remember, the future belongs to the owners. We'll see you in the next one.